Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, you must have heard Value Research emphasize the importance of not investing in companies and funds without a track record. That's why we, time and again keep telling you not to invest in IPOs. But does the same rule apply to mutual funds? Should they be investing your money in IPOs? That's what we'll discuss in today's episode with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
In recent times, there's been a lot of criticism around mutual funds investing investors' money in new age companies like Paytm or Zomato or Mamaearth most recently. What do you think is the rationale behind mutual funds investing in IPOs in the first place?
Of course, every mutual fund invests to make money. Now, they go wrong. And most of the time they go right. And if they go right, then it translates into meaningful returns. Once in a while they go wrong. And if they go wrong with a company which is older, people don't notice it. Nobody comes and decides that, okay, you invested in this company and ever since you invested, it went down by 10%. And why did you do that? In case of IPOs, it becomes noticeable that this company did not exist. You bought it at this price, you bought it at IPO, and ever since then it has gone down by 30%. I think, mutual funds do invest with a mindset of, making money in the short run or in the long run. There are two aspects to this. One is that it is interesting to talk about that, oh, look at this. Here is a great fund manager who is expected to be an expert. And why he's doing such a thing that, where he goes wrong and more likely to go wrong. And then the second aspect is that people actually, what they don't, take into account is what is the context? What is the portfolio view he has taken? Maybe a fund manager has just invested 100,000 shares of a company. And with a mindset that, okay, here is, if I get an allotment and if it trades at 10% premium to its IPO price, he will sell. He may not be a long-term investor. The mutual fund managers are always a combination of 2-3 things. They are a long-term investor with many stocks. They are a short-term investor with some stocks. And they are a tactical investor with many stocks. I don't know what these stocks are. And mutual funds do have, if there is a possibility that there could be a bad company. It may not make money. The company may not make money. But there is a demand-supply dynamics in the IPO where it becomes a very favorable lottery. If you get an allotment, you will make money. If the fund manager is of that view, so there could be many things which could be driving that decision. And one should not forget that despite all this, it is not very alarming because in the context of a mutual fund, when it is a 1,000 crore fund and if the fund has invested 10 crore rupee, how meaningful it is. And normally these new generation IPOs are even smaller component of the overall fund.
But do you think that mutual funds are taking unnecessary risk by investing, investors' money in these new age IPOs? And how different is that from an investor investing directly in such companies?
The one is that investors, I don't think fund managers are taking a disproportionate risk. Because as I was saying, that the sense of proportion we should not forget. Whether it is 0.0025% of the portfolio, it might look like 5,000 shares, 50,000 shares, 5 lakh shares. But in the overall scheme of things, in the overall context, how meaningful it is, that is one. The other is that I would be worried about a fund which is taking such calls and going wrong often. And that will show in its poor performance, and that will not be part of our recommendation. It will not be part of our things. An investor's framework of choosing a fund in the first place. So the bottom line is that the fund should do well consistently over a period of time. And if it goes wrong overall, it will not be doing well consistently over a period of time. So I don't think, it is that alarming. But at the same time, I would be very wary of a fund which is taking such calls very often and going wrong.
Okay, and how different is this thing from an investor investing directly in IPOs? Because that's what we've been advising against.
It is no different, except that when an investor does it, of his 50 lakh rupees, he just might be doing for 2 lakh rupees or 5 lakh rupees, which could be more. In case of a mutual fund, it could be very insignificant it might be very noticeable. It might be talked about. It might be the talk of the social media. But it means nothing, because in the overall scheme of things, it might be insignificant. In case of an individual investor, there are two problems to it. One is that if you are going to invest 2 lakh rupees in an IPO, then you have to keep 2 lakh rupees handy, which means that you will not be doing that SIP. And there could be occasion when there could be 5 IPOs scheduled in this month, or could be. So will you keep that much of liquidity? I would say that if I have to choose between increasing the amount of my SIP as compared to investing in an IPO, I will give IPO a pass.
All right. In this scheme of things, how worried should an investor be with mutual funds, taking such calls?
I would say that not at all. It is insignificant. Just take note of it that these funds are doing it. And if they stop doing well, the fund themselves, if they stop doing well, you can actually blame it on their attitude towards what kind of risk they are willing to assume. And what is the kind of, where do they tilt in terms of what is their betting average? Do they go wrong? Do they go right? Because, after all investing is about taking a call on a company and its likelihood of doing well. And if you take a call and you go wrong often and it does not work out, it does not play out favorably for you, he's not a desirable fund manager to be entrusted with your money. So that is something which you should keep in mind. Whenever so looking at fund performance is one aspect, and I think the most crucial aspect, that is it in line with what you expected. I will be careful about a certain kind of fund. Like, for example, if there is a fund which has a given mandate, a thematic fund or a sector fund or a kind of fund or a small cap fund which is investing in a large cap company or some such thing, those kind of style impurity, if somebody is getting distracted and investing in a company which does not fit into its portfolio, then I think that I'll be more alarmed by those things, those indiscretions, than a fund investing in an IPO of a company which does not make profit. Individual investors do variety of things. Just last Diwali, gold coins were available in Blinkit. And it was getting home delivered. So, and then you keep investing in IPOs and you do some and you remember the ones where you made profit and you forget about the ones where you made losses. I think, be disciplined about your investments and don't get distracted by so much, because there could be a great fund which has invested in one of these IPOs. And because it is getting bad press, you will be distracted. You'll start holding a negative view on that. That is avoidable.
All right then, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.